Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're looking at the industrial real estate outlook across the Northeast Corridor. This is the second in a four-part mini-series on industrial. The folks at Marcus & Millichap recently published their 2026 industrial forecast for 36 metro markets across the U.S. And today we're going to focus on 6 of those markets: Boston, New York, Northern New Jersey, Philadelphia, Baltimore, and Washington, D.C. These markets are connected geographically by the Interstate 95 corridor, but they're not all moving in the same direction. There is a common theme. The wave of new construction that affected all industrial markets over the last several years is starting to recede. For much of the recent cycle, new deliveries have exceeded absorption. And when supply grows faster than demand, of course, vacancy rises, and of course, rates drop. That's exactly what happened through much of the Northeast. Now, construction pipelines are contracting. That doesn't automatically mean these markets are healthy. It means the imbalance between demand and supply is starting to correct. Let's start with Boston. Boston experienced the largest amount of net space relinquishment since 2004. Many tenants have expanded aggressively during the previous cycle, have started giving back space. So not only has there been new supply from new construction, quite a few tenants have been reducing their footprints. Employment also contracted by 0.3%. Representing the metro's largest job loss since 2020. Those are not strong demand indicators, but the rate of deterioration appears to be slowing. And I apologize for the double negative there. The increase in vacancy during 2025 was the smallest in 3 years, and the market is expected to move closer to stabilization during 2026. Vacancy is forecast to finish the year at about 10%. Asking rents are projected to remain essentially flat, increasing by 0.1% to $12.05 a square foot. But Boston is not yet a growth story. It's a stabilization story. As we move south to New York City, we see a similar pattern. For 4 consecutive years, new deliveries have exceeded absorption. That imbalance is expected to narrow quite a bit this year. Vacancy is projected to increase modestly to about 9.1% before beginning to compress. Rents are forecast to resume growing, reaching roughly $24.85 a square foot by the end of the year. About 700,000 square feet of new industrial space is expected to be delivered, and in the market the size of New York, that's fairly insignificant. The strongest demand remains in small bay infill product. We saw that in the Southeast in yesterday's episode. Large distribution buildings continue to face a more difficult leasing environment. That's a reminder, of course, that industrial is not a single asset class. A 20,000 square foot infill warehouse serving local business is very different than 500,000 square foot regional distribution center. They might share the same industrial label, but they serve very different customers, and they respond to different economic forces. Across the Hudson River in New Jersey, the area stands out as one of the stronger markets in the group. It's really part of the New York area. The most compelling activity is taking place in the infill corridors, particularly along the New Jersey Turnpike, which is, of course, I-95. Tenants want proximity to population. They also want shorter delivery routes, lower fuel costs, and better access to the end consumer. Investors are looking for properties they can acquire below replacement cost or achieve a lower basis than would be possible through new construction. Vacancy is forecast to finish the year near 7%. That's approximately 140 basis points lower than the national average and one of the lowest vacancy rates among the 6 markets we're talking about today. Rents are projected to increase by 1.4% to about $14.90 a square foot. So you can see that the rates are roughly half of what they are in New York City. At the same time, construction is expected to decline by about 20% and is about 2.3 million square feet scheduled for delivery. When you combine the constrained supply, the strong population density, and the continued demand for last-mile locations, that northern New Jersey area has some of the more resilient fundamentals in the Northeast. Next is Philadelphia. Philly is showing early signs of a turnaround. The market recorded net space relinquishment during the second and third quarters of last year. And that's the first time since 2009 that Philadelphia has experienced 2 consecutive quarters of negative absorption. Demand then improved in the fourth quarter. Vacancies increased by more than 500 basis points over the last several years. That is a meaningful increase, and the market still has a bit of excess space to absorb. The construction pipeline is shrinking quite a bit, falling to about 3.2 million square feet. That reduction in supply should help vacancy begin to compress through the balance of this year. Rents are projected to increase by 1.7% to $10.36 a square foot. That's following a 6.5% decline last year. Philadelphia also recorded one of the stronger employment gains among the major U.S. metro areas. But we have to remember that the performance varies widely by submarket. Some of the outer suburbs are seeing some of the strongest leasing activity, while the other areas in the core remain softer. When you underwrite a market like Philly, a metro level vacancy number is not enough. You need to understand the specific submarket, the building configuration, the tenant profile, and the competing supply within a very small radius. We always know that real estate is hyperlocal and industrial in Philly is also hyperlocal. Baltimore is a different story. We've seen negative absorption in 6 out of the past 8 quarters. That's clearly a weak headline. But leasing activities increased modestly over the last 12 months across both large bay and small bay properties. That might be an early indication that demand is starting to stabilize, even though it's not yet shown up in the aggregate numbers. Vacancy is forecast to rise to about 11.1% by the end of the year. Rents are going to stay fairly stable around $10 a square foot, ending 2 consecutive years of decline. Deliveries are expected to fall to about 1.1 million square feet. I frankly don't understand why there's any construction happening in Baltimore right now, but they remain a strategically important market because of the transportation infrastructure and access to major cargo routes around the Mid-Atlantic corridor. This is a market that's going to require some patience. The investment thesis cannot be simply that vacancy is high and therefore the market has to rebound. You need a specific reason why demand is going to return to your property in your submarket during your investment time horizon. And then finally, let's look at Washington, D.C. Across all of these 6 submarkets, Washington has demonstrated some of the strongest rent resilience. It's the only coastal metro in the group that has not experienced year-over-year rent decline since 2021. Absorption has helped limit the increase in vacancy, and the 2026 delivery pipeline is expected to be the smallest since 2020. Vacancy is projected to finish the year at 8.2%. That represents an increase from 8%, only about 200 basis points, but the increase has been relatively controlled. Over the last 5 years, rents have grown at an average of 8.2%, the strongest sustained performance in this group. Rent is expected to moderate during 2026, with asking rents about $14.35 a square foot. The major risk in Washington, of course, is employment. Federal layoffs are affecting the regional economy, and total employment is expected to decline by almost 1%. There's also an increasing divide between core and suburban locations, and that divergence will influence where tenants lease space and where investors choose to allocate their capital. So, what conclusions can you draw from these 6 markets? First, the construction pipeline is contracting almost everywhere. That is the most important factor for existing owners. When supply slows, the market at least has the opportunity to absorb the excess inventory that was delivered during the previous cycle. Second, northern New Jersey and Washington, D.C. appear to have the strongest current fundamentals. Northern New Jersey benefits from dense population, last-mile demand, and constrained infill locations. Washington has demonstrated sustained rent growth and relatively steady absorption, although the federal employment remains a meaningful risk. Third, Philly and Baltimore look like recovery markets. There could be opportunities to acquire bargain, but investors need to be selective. The overall picture is that this appears to be primarily a supply correction, not a collapse in demand. Tenants are still leasing industrial space. They're simply being a lot more disciplined about how much space they take, where they locate, and how efficiently they use that footprint. And when the construction pipeline contracts, the tenant discipline combined with that will eventually work in favor of the existing landlords, but it's going to take some time. Of course, the reduction in supply is only part of the equation. You got to worry about capital costs. You got to worry about all these other things. So a successful investment needs, of course, the right purchase price, the right submarket, the right building, the right credit structure, and a credible path to stabilized occupancy. So that's a snapshot in the Northeast Industrial Outlook for 2026. As you think about that, have an awesome rest of your day. Go make some great things happen. And we'll talk to you again tomorrow.